Hello, and welcome to Topic 10, Property, Plant, and Equipment. So our learning objectives for this topic is to identify the costs that will be included in property, plant, equipment, various valuation models that are available for PP&E. How do we prepare the entries to account for the initial acquisition of your property, plant, equipment? What happens when these assets are exchanged for monetary or non-monetary assets? Subsequent cost acquisition, disposition of your property, plant, equipment, and the financial statement representation, and of course, the differences between IFRS and ASPE. So let's start with our property, plant, and equipment, the basics of this. So property, plant, and equipment is really defined the same under IFRS and ASPE standards. So the two criteria that we need to consider is, are these assets used for generation of sales? If they are held for use in production, they are helping the business generate revenue, then these can be classified as property, plant, equipment. The other criteria that we do look at is the life of your asset. So if the life of your asset is over 12 months and the asset is helping the business generate revenue, then both of these criteria are met, which means we are looking at a property, plant, equipment item. Now, with the property, plant, equipment item, then we look at the physical substance. So if the physical substance exists for that asset, then we slot it into property, plant, and equipment section. If the physical substance is not there, then we call it as intangible asset. But the criteria still remains the same for the for property, plant, equipment as well as for the intangible asset. So property, plant, equipment are also called as tangible capital assets, plant assets, or often fixed assets. So some of the items that we will see under these section is your office, factory, warehouse buildings, investment property, any equipment, and the mineral resources. So once your capital asset is recognized, then we have to amortize these assets because these assets have limited life. So the assets have to be amortized over its useful life. So in the property, plant, and equipment scenario, that terminology is depreciation of property, plant, and equipment. Under intangible assets, we call this as amortization, but conceptually, they are referring to the same idea, which is the allocation of cost of your capital asset over its useful life. Now, componentization, when you have a single asset, we try to recognize it into different components as much as possible. Say, for example, the roof of your building. It's going to have a different useful life in comparison to the building. That is why it becomes a different component. So we try to keep these assets into as many separate components as possible. But again, we don't want to overdo that because too many components can become confusing as well. Capitalization of your property, plant, and equipment. So the recognition criteria to capitalize any cost related to your capital asset is, first of all, is that cost measurable? Secondly, is there future economic benefit from that asset which will flow to the entity? If both of these criteria is met, then we are in a position to capitalize that cost. So your capitalized costs for property, plant, equipment are going to include all of the expenditure that the business incurs in order to acquire the asset, any other costs they incur in order to bring that asset to a usable condition, such as your site preparation, any installation, delivery, any professional fees paid, any assessment, basically anything or any money that is incurred, any expenses that are incurred to bring the asset to a usable condition. Likewise, at the end of the asset's useful life, if there is any cost related to discharging of the obligation, then we have to account for that as well. So the assets that do not have a future economic benefit, but are necessary to obtain benefits from related assets can be capitalized as property, plant, and equipment. Costs that are not capitalized. So when we say the capitalized cost for a property, plant, equipment, we said any cost that the business incurs in order to bring your asset to a usable condition can be capitalized. But at the same time, there are certain costs that do not meet this criteria and hence should be expensed. So ideas such as your initial operating losses, any money the business has spent on training the employees, reorganizing the operations, general administrative overhead costs, the cost of opening a new facility, introduction of a new product, operating in a new location, and any repairs and ongoing maintenance. So any criteria that does not meet, or any item, any expense item that does not meet the criteria will have to be expensed. Let's talk about the cost elements related to property, plant, and equipment. So first of all, we are looking at your self-constructed asset. So these are the assets that are constructed by the business for use in its operations. So the type of cost that we can include for the self-constructed asset is your direct material, direct labor, and any other directly attributable overhead, which is variable manufacturing overhead. Any abnormal amounts of wasted inputs and any other excess related cost will have to be expensed. We cannot capitalize these. Dismantling and restoration costs. So when the asset comes to its end of the useful life, any costs that are related to the retirement of your asset can be capitalized. So we debit your asset and we credit the liability account. Okay, so because the actual expenditure is not going to be incurred for a long period of time, that liability is booked at the present value of the future cost. So that liability would have to be amortized using the effective interest rate method, and that asset is going to be depreciated just like the regular assets are depreciated. Non-monetary exchange for your assets. So when you are looking at the cost for your non-monetary exchanges, so generally the cost is defined as any amount of cash or cash equivalents that is paid, or the fair value of the consideration that we are giving up to acquire a piece of asset. Now that amount of the cash cost is not always obvious. So in those cases, the common issues when you're looking at the exchange at the acquisition can be the cash discounts not taken, any deferred payment terms that are available, lump sum purchases that are made. With your non-monetary exchanges, we are looking at the share-based payments and the asset exchanges, your contributed assets as well as the government grants. So these things can make the exchange of the non-monetary assets rather complex. But what does the non-monetary or monetary asset really mean? So your monetary assets are the assets that have the money or the claims to future cash receipts. We know the amount of cash that we will be receiving. So for example, your cash account is monetary, accounts receivable is monetary, because we know the exact amount of cash we will be receiving in the future. Non-monetary assets are the ones that do not have a fixed claim or a determinable claim on the cash flow. So think of your inventory. The inventory will eventually convert to cash, but we just don't know for how much. It's not very solid. Okay, your long-lived asset, the same idea applies, and your equity investments. So these are your non-monetary assets. So when these non-monetary assets are disposed of, and in exchange we get a monetary asset, then a gain or loss is going to be recorded on that exchange. That gain or loss is going to hit your profit and loss. But when a non-monetary asset is exchanged for another non-monetary asset, then we have to look at the cost of the asset acquired is going to be booked at the fair value of the asset that is given up, unless the more reliable number is the fair value of the asset received. Okay, so your first consideration always is incoming asset will be recorded at the fair value of the asset that we are giving up, unless, of course, the fair value of the asset coming in is more reliable, then we use that number. The exchange cannot be recorded at the fair value if, of course, the fair values can't be reliably measured. The exchange transaction have to have commercial substance. And what that commercial substance really means is that there has to be a significant change in the company's expected future cash flow in comparison to the cash flow right now. So that relates to your amount, timing, or the risk of the new future cash flows is different from those cash flows of the asset that we are giving up. Entity specific value of the new asset differs significantly from the value of the asset that we are giving up. So when an asset is acquired, it cannot be recognized at more than the fair value. So exploring that idea a little bit more. So your exchange transaction has to have your commercial substance. So with the commercial substance then, if your transaction has the commercial substance, then we are going to apply the fair value standard. What that means is the cost of the asset that you have received. It will be booked at the fair value of the asset that we are giving up, unless, of course, the fair value of the asset coming in is more reliably measured, in which case the gain or loss is going to go to your profit and loss. If the transaction lacks physical substance, then in that case, this is an exception to the fair value standard, where the cost of your asset received is going to be the carrying value of the asset that we are giving up. So there is going to be no gain that will be recognized, but the loss is recognized if the fair value of your asset acquired is less than the carrying amount of your asset given up. Let's look at costs that are associated with specific assets, such as your land. So when you're considering the cost of land, you are looking at the purchase price, any closing fees, legal fees, any cost of getting your land ready for use. Say, for example, if a piece of land was purchased with the old building that business has no use for, and they intend to demolish that building and construct a new one, then all of that cost of clearing, removal of the old building, grading, filling, draining, all of that is part of the land cost. You have the any liens or encumbrances, any taxes in arrears. If they were part of your land acquisition cost, then they are part of the land asset as well. If you have any improvements with the indefinite life, then that is also part of your land asset. Any sale of any money that we get from the sale of old buildings material will reduce the cost of your asset. Land improvements are the improvements that are done on land, but these items are kept separate because they do have a finite life. Land does not have a finite life, so land is the only asset that is not depreciated or amortized. But land improvements, such as your landscaping, fences, driveways, walkways, parking lots, all of these are going to have a defined life. So they are going to be put in a separate account for land improvement, and they will be depreciated based on their useful life. Looking at the buildings, our net cost for the removal of the old building that we had discussed previously to construct a new building, all of that is going to be part of the land cost. But once your land is ready for use, then any cost incurred in order to build the new building becomes part of your building cost. Leasehold improvement relates to the long-term lease contract. So if the lessor has done any capital improvements on the leased property, then these improvements will become part of the property, and the the property, these improvements are going to be belong to the lessor at the expiration of the lease. Okay, so lessee is doing the improvement, but the improvements will go to the lessor at the end of the lease term. So we call that as lease improvement. So construction of a building on a leased land, improvement of the leased building are some of those examples. Now these costs are kept in a separate account for leasehold improvement, and they will be amortized or depreciated over the remaining useful life of that lease term, not the asset's useful life, because the asset will belong to the lessor at the end of the lease term. The improvements are done by the lessee, will belong to the lessor at the end of the useful life. That is why depreciated over the lease term, not the useful life. So a fine distinction to keep in mind. Related to your equipment, we will see a lot of different types of equipments in the account, such as your office equipment, delivery equipment, fans, machinery, your furniture, fixtures. So what we get to include in the cost here is your purchase price, any freight and handling charges, insurance while the asset is in transit, any specific cost related to bring your asset to a usable condition, such as your foundation, assembly, installation, any net cost of trial runs. cost of adjustments to make the operations as intended, but any cost that is recoverable will not become part of your asset cost, such as your taxes. Lastly, we are talking about the investment properties here. So investment property is a property that is held to generate rental income. Um, and here, for the investment property, we get to include the asset that is currently under construction. The standards under IFRS and ASPE are pretty much the same when we are looking at the treatment of investment property. So related to your property, plant, equipment, what are we going to do with the measurement after the date of acquisition of your capital asset? So from the accounting standpoint, we have three different models that are available related to property, plant, and equipment measurement. One is the cost model, which is the most widely used model. This is the only model that is available under ASPE. So here your asset is recorded at cost and it is depreciated over its useful life. And at certain time periods, we do look at the impairment on these assets. So your asset is going to be reflected at cost minus accumulated depreciation minus any accumulated impairment losses. Next off is your revaluation model. The revaluation model is available under IFRS, and this can only be used to remeasure property, plant, and equipment items under IFRS. So here, your property, plant, equipment are carried after acquisition at their fair value. So at the date of your year end, the assets are revalued to their fair value. Okay. Now, generally speaking, there is not a specified time frame when it comes to revaluation model. The businesses need to either do that at a certain frequency or when there are indication that the value of the asset has changed. Okay, it doesn't have to be done annually. So that is not a strict requirement, although the company might end up doing that. At the end of the day, the asset is going to be reflected on your statement of financial position at the fair value on at the um, will be reflected at the fair value. Okay, the depreciation is taken on the revalued amount, and any gains and losses are going to be adjusted against these assets. They will hit your P&L. Then we have the fair value model that is again only available under IFRS, but this model relates to the investment property. So under the investment property, there are two models that are available. So the companies have a choice of either going with the cost model or they can go with the fair value model. Regardless of which model they go with, the companies have to make sure they revalue their asset to the fair value, indicate that information in the notes to the financial statements if they are using the cost model. If they are using the fair model, then at the end of every year, in this instance, it is a requirement that the businesses revalue the asset at fair value on their balance sheet date. Like with the revaluation model, there wasn't a fixed time frame defined, but with the fair value model, it has to be done every year. There is no depreciation that is booked on the fair value asset, but if the business is following cost model, then they will go ahead and depreciate it, but they do have to check for the fair value and disclose that information in the notes. Let's look at impairment. So impairment will occur when the carrying amount of your long-term asset is greater than its future economic benefit to the business. Now that can be evident from the external and internal indicators to assess possible impairment. So the management needs to regularly evaluate the assets for the indicators of impairment. So under IFRS, we are required that this is done at the end of each reporting period. Under ASPE, we can wait until there is an indication that the carrying value of your asset or the recoverable amount has changed, meaning that there is a trigger, which can either be an external or an internal factor. So the external and the internal factors, the external factors is the change in the technology, change in the marketplace, the economics have changed, the legal environment has changed, the market interest rates have changed. market capitalization is exceeding the carrying value of your net asset. So some of these are some of the examples for your external indicators. The internal indicators are your obsolescence, any significant changes in how the asset was used, and we report that information has worsened, meaning that there is increased downtime. So all of these are internal indicators of impairment. Once the business recognizes based on the external or the internal indicators that there is impairment, then we get to account for the impairment. But we always have to check for the indicators first. So now when you are looking at the assets, sometimes the assets do not have the ability to generate cash flow independently. So in that case, we are not able to apply the impairment to these assets on an individual basis. So what we do is we take these assets and put them in a group. That group of asset generates inflows and outflow of cash predominantly, that is independent of the other cash flows. That group of assets is then called as your cash generating unit, which is a CGU. So now here there are two models that are available. There is a cost recovery model and there is a rational entity impairment model that is available for impairment on your CGU, that is your cash generating unit. Now, no individual asset can be reduced below its fair value if the cost recovery model is used. But if the company is using the rational entity model, then it cannot be reduced below the recoverable amount. So if the assets carrying amount is going up, okay, it is increased. In that case, the amount or the difference is recorded as a credit to your revaluation model. So your asset is going up, you're going to debit the asset. You're going to credit the revaluation surplus OCI account, which is a type of an equity account. But if it takes the other direction where the carrying value is going down, that is credited. So your asset is credited, you are going to debit that same revaluation surplus OCI account. But in this case, the account cannot have a debit balance. Okay, the normal balance in the OCI account is a credit. So overall for that account, if it has a credit balance, then that's good. But if it cannot have a debit balance overall. Okay, under the increase of the asset on the left-hand side here, we can recognize that as an increase in the profit or loss, but only to the extent it reverses the revaluation decrease from the same asset in the previous years. So there can be no net increase in the net income from the revaluing the asset over its useful life. So the two choices that we have when it comes to disposing of the OCI account balance is either the business can transfer the amount to the retained earnings. Alternatively, the balance can remain in the revaluation surplus OCI account until the asset is retired or disposed of. At that point in time, the balance can be transferred to the retained earnings. Okay, so it will eventually come to the retained earnings either now or at the point of disposition. Property, plant, equipment costs that are incurred after acquisition, what are we going to do with those? So it entirely depends on what is the nature of those costs. So if the cost is incurred to achieve greater future benefit, meaning that the either performance of your asset is changing or the life of your asset is changing. If either of those two things are changing, then we refer to that as a capitalized expenditure. So some of the examples of your capitalized expenditure is an addition where you are increasing or extending the existing asset. You're adding, let's say, a different wing to a building, okay? Replacement or major overhauls and inspection, rearrangements and installation. So all of these are your capital expenditure cost, meaning that we get to capitalize it, and then you would have to revise your depreciation from that point onwards. But if your cost is more of a regular repairs and maintenance type of a cost, then these costs can never be capitalized. They are referred to as revenue expenditure, meaning that we will have to expense these. What happens to your asset at the point of derecognition or disposition? So at the end of its useful life, Or practically speaking, even during the life, sometimes the asset has to be disposed of for a various number of reasons. It could be a sale, it could be an exchange, it could be voluntary disposition, involuntary disposition, retirement that the company had planned, or a donation. So basically, the reason for getting rid of the asset um, is not as important. The way the asset is going to be accounted for, regardless of these reasons, is the same. Okay, so the first thing we have to do here is make sure that your asset has depreciation recorded up until the point of disposition. Any gain or loss is going to be recognized into your P&L. Okay, your profit and loss will see the gain or loss at the point of disposition. So once your depreciation has been updated, then we get to dispose of the asset, compare the carrying value with the proceeds. The difference is your gain or loss, which will hit your profit and loss. Looking at your assets held for sale, and this is the same idea we had discussed in topic number 3. So these are the long-term assets that are classified as held for sale when the company intends to sell or dispose of these assets by sale in the short period of time. So held for sale assets are going to be carried at the lower of the carrying value and the fair value minus cost to sell. Any losses at that point in time will be recognized into profit and loss. They will be reported as your current assets on your statement of financial position. Hence, there will be no depreciation on these assets once they are classified as held for sale. Any subsequent increase in the net realizable value may be recognized as a gain as long as it is only to the extent of offsetting previously recognized losses. ASPE is going to allow the classification as current asset only if sold before the financial statements are completed, else we do not change the classification of your held for sale assets under ASPE. And lastly, we are looking at the IFRS and ASPE comparison. So a lot of times, the nature of the disclosure that is needed under ASPE and IFRS, this is quite extensive. So we are looking at any outstanding contingencies. What is the depreciation rates that are used? How did we determine the impairment? What was the total loss of that? What were the nature and circumstances? Were there internal or external factors that were determined? Is there a change in the asset's fair value due to measurement or remeasurement? So all of that goes into the notes disclosure. But when we are looking at the comparison between ASPE and IFRS, it basically boils down to the different models that are available. So under ASPE, we only have the cost model that is available. Under IFRS, we have the cost model, revaluation model for property, plant, equipment, and fair value model that is strictly for the investment property. Your net revenue of the property, plant, equipment before being ready for the intended use. Under IFRS, we include that as part of income. Under ASPE, we include that as part of the asset cost. Your asset retirement obligation. Under IFRS, this is capitalized because it is a legal or the constructive obligation. And under ASPE, that is the capitalized legal obligation only. Okay. If it is a constructive obligation, then it does not have to be capitalized under ASPE. And constructive obligation really is something that the company has done out of the goodness of their heart. They are not required to do it, but they are just doing it as a business practice. That is a constructive obligation. That concludes topic number 10.